So what GAAP requires is that we set up a method to estimate what we expect will not be collected. So, and we set up a contra asset account called allowance for uncollectible accounts, and that's a reduction to the accounts receivable that we've booked at gross value. So when I make a sale to a series of customers for say $100 million, if I expect half of 1% aren't to be collected, then I have to set up an allowance. So I don't actually recognize the full $100 million of sales. I'm going to only recognize 99.5%. The difference is going to be an allowance for uncollectible accounts, and that's a contra asset that reduces both the value of my sales and the value of my receivable. And there's a variety of ways of doing it. It can be percentage of sales, it can be percentage of receivables, it can be based on aging. Now, there's no one methodology, but whatever methodology I use, I have to use it consistently. I have to make sure that it approximates what actually happens. And the way I work it is I debit bad debt expense and credit allowance for doubtful accounts. Okay, so internally, this is what you would see. The gross value and then the allowance for uncollectible accounts. Externally, I would just see the 140,000, but internally, as I mentioned earlier, we're going to look at the details. Okay, and then there's a write-off process when I don't receive them. Okay, and here's the accounting for that. Some companies, and not many, but some companies have what's called notes receivables, and there's a variety of reasons why that may happen. So it may be customers who need extended payment, loans to employees or subsidiaries, I'm selling property, plant, and equipment. So these are things that not in the course of business, or some lending transaction. And so it's a written promise to pay. It's a negotiable instrument. And just like if you went into a bank to sign a automobile or mortgage, it's very formal. And sometimes the companies do this zero interest bearing. If they do that, then we have to look at what the time value of money is and discount the amount based on time value of money. Okay, and that gets involved with looking at what so what I would recognize for a receivable is what I expect to collect in terms of time value of money. So I'd look at what the discount rate I would apply, and I would utilize that to assess what I expect to collect. So let's say that I sold some property, plant, and equipment to another company, and they're going to pay me $10 million over 5 years. I don't recognize the whole $10 million as a notes receivable. What I would do is say, what's the time value of money? So if the time value of money says that if I collect that over a 5-year period, in today's dollars, it's actually worth $9.5 million, then that's all I would recognize as a notes receivable. And so I need to make an adjustment when I have a long-term payment stream coming in from somebody. So this is a relatively unusual accounting situation, but one that can occur from time to time. And that's only for zero interest bearing notes. If I'm collecting interest, then I'm going to recognize interest income, and I'm going to again consider the time value of money, but so here's the accounting entry. When companies are struggling for cash, sometimes they'll sell their accounts receivables. There's really two standard ways of selling accounts receivable. One is called a factoring, and the other is pledging. So a factoring is I sell them outright, usually at a relatively steep discount. Another is it's called factoring, where pledging, where basically somebody's giving me a loan and I'm pledging my receivables as collateral for that loan. And so when I collect the money from my customers, I basically repay the loan. So they're both relatively expensive ways to raise cash, but companies that are strapped for cash in the short term sometimes resort to these methodologies. So, it's fairly standard. If I factor them, sometimes it can be with or without credit review. So sometimes if in some cases, I need approval from the company that I'm selling it to make the sale to my customer, and sometimes not. It depends on the arrangement, but in that case, you're really giving up control of a key decision if you need credit review from the company that's buying the factoring company. So factoring with that methodology is you're really relinquishing a lot of control, and you're also going to pay a relatively steep discount on the receivable. But again, happens to companies when they get a little short on cash and need to pay their bills. So you can have a sale without recourse. So without recourse means that you assume the risk of collection, and I'm sorry, the company that you sell this to, your receivable to, assumes a risk of collection. And when that happens, you're going to get a much steeper discount than if there is recourse, which means that when I sell my receivables to a factoring company, if the company doesn't, my customer doesn't pay, then I'll bear the loss, in which case the discount will be less, but the risk is higher. So we want to account for things a little bit differently depending on whether it's with or without recourse. So here's an illustration of that. And there's some more accounting entries. So not really a focal point of this course, but one of the things that does happen is an important metric for investors and creditors is to analyze through ratios certain metrics, and receivables is one of the metrics that gets a lot of attention. And if you think about it, what a receivable tells stakeholders, creditors, and investors is a couple of things. First, it indicates how efficient we are in being able to collect money from our customers, and the other, it may give an indication about the satisfaction of our customers with our products or services. So to do that, there's something called account receivable turnover, and basically we want to know how long does it take to collect receivables from our customers. So typically we expect, let's say on average, 30 days. And so what investors and creditors look at is a trend. Is the trend improving or getting worse? Is there any significant movement? And if so, why might that be occurring? Is it that because we're not putting the focus and energy on collecting receivable, or is it because our customer's not happy? So that, again, a little bit outside the scope of our course, but we should recognize that in addition to the basic financial information that we get from financial statements, analysts are constantly assessing ratios and trends and comparing our trend over time and comparing us to others in the industry to see how efficient and effective we are with our utilization of our resources.